Welcome everybody. How we doing? Welcome everyone. How we doing? I was a little late getting the link posted today. We'll give it a few more minutes, see if we get some more people in here. Real quiet week in the group though. Well, voice chat's been packed, but everywhere else been quiet, so we'll see how attendance is. But how'd everybody do today? Good days? Bad days? Hopefully we all had some fun. Nice. That'll probably save you a lot of stress over time for sure. As long as you're buying enough time on your contracts that you really don't have to worry about those, the intraday movement, you should end up pretty happy. I mean, of course, entry is still crucial in all trades, and stop outs are still crucial, even if you got time. Uh, I think one of my most hated excuses of people, being down really bad and their reasoning for it is I have time. I never think that's the best reason to hold on to something. So it's trading with time though definitely gives you some peace of mind. Makes it so you don't really have to worry about things. Much more focused on how those 4 hours and hourly candles are closing as opposed to how some of these 5 minute or 15 minutes might be closing. Welcome everyone. Like I said, we'll give it a couple more minutes. Not sure how attendance is going to be. Been a quiet week so far. Um, but give it a couple more minutes, see if a few more people want to show up. How'd everybody do today? We only got a few of us in here so far, but hopefully everyone had a pretty good day. We went on a heater there at the end of the day, and bro, that's for sure. Nice. It's good. Yeah, we hit a nice, we hit this apple bounce this morning. We hit them somewhere around here. I guess since we got them in, I can just show you the actual trade. So not only was I kind of not buying the bluff on the break, the first like just knife through here. We were starting to see buyers show up on most of the tech names at this point. Obviously, all those tech names, everything got hammered midday. But we were starting to see some buys show up on a bunch of those tech names, but Apple was the laggard. So as soon as I saw some big sell candles, then all of a sudden I see it's basically doji out where the market's trying to have some indecision. I start to look for reasons to get in there on the counter trend trade. That's just what I like to look for in this situation. So one of the main ways that I'll do that, or some things that I'll use to help me look, is the B bands. And so, obviously they're super ugly. I've talked about them in a couple of classes. But B bands are all based on statistics and probabilities of things happening. And so this first candle closed outside of the third, barely, but outside of the third standard deviation. This next one closed basically right at it. There's a 99% chance that you move out of here, statistically speaking. So that was why we took our entry. We took our entry right around here. I just took them up. This middle pink line is VWAP. These other two are the B bands. I just took them up to the VWAP. I know a few more people wrote them up here. And then obviously the breakdown right here, perfectly reasonable to get short on Apple there. But yeah, we had a nice little one on Apple there today. And then it was another one that, I always look at these longer time frames, and obviously, this didn't hold eventually. But when I zoom out and I see this and I see that we're basically at one of the most major spots on the Apple chart, I try calls there every time. And then obviously the breakdown came, and then no surprise, it bounced exactly where you would have expected it to bounce today. A lot of the names did that. They all lined up at bounce points, and we got that nice pop into close on most of those names. Obviously didn't recover all of the selling. Still a real bad day for Apple, but nice big pops into close. A lot of big buyer volume. Even the market on close imbalances were all imbalanced to the buy side. I'm sure some of that was people closing shorts, but it was also people wanting to be in there long. Okay, give me one more second. It was a don't feel bad about closing red. Days like today are hard for people. And we're gonna talk, tonight we're talking ranges, of course, but just this just goes for everybody. Days like this are hard for people because, people got bearish after the first candles, then they get bullish by the highs, then they get bearish down there again at these lows, saying, oh no, it's not going to hold. Bounces come. And so there was a lot of flip-flopping. Then ultimately big sell came. I missed none of this. I had stopped basically by right around here, so I didn't catch any of this and started trading later in the day. Big old sell. By the time that big old sell came, people were chasing the short. And so, we definitely saw a lot of it today where people chased the longs, people chased the shorts. Again, people chased the short that actually paid. And there was obviously, this is nice, a couple bucks move on SPY, plenty of money to be made on those downside moves. But the short chasers were hoping for more of this. And unfortunately, they got met with some of this, So don't feel bad about ending red today. We're gonna talk about, just some things to look for. These, I don't remember my exact schedule on these next couple classes, but we did trading trends last week, trading ranges, obviously this week, that's what we're doing now. Price action is going to be next week. Or no, contract selection next week, and then price action after that. And so, this is and I guess we'll kind of slowly get started here. We got a few more people pulling in. So this is again, Dirty River. Happy to have you here. Thank you everybody for showing up like always. I really appreciate the support. And today we're talking trading in ranges. For anybody who doesn't know, this has been kind of my beginner series. I don't think the beginner series is the best way to put it. But it's what I consider trading essentials, the things that I look for every day, the types of things that I watch. We did, support, resistance, trends, EMAs, so far. I think that's all we've done. And then, oh yeah, trading, drawing trend lines and then trading in trends. Now we're doing trading ranges. Following week is contract selection, where we can really start to think about, because we can talk all about these trades, but such an important part is contract selection. And you don't want to be that person that's, in the $50 out of the money weeklies that we all make fun of behind your back. You want to be in reasonable contracts for the right reasons. And then after that, we'll do price action, which is really where we kind of, you know, it's basically the lecture where we put everything together. We'll go through charts. We'll just kind of go day by day over a couple of weeks, and talk about how we would have traded it, just analyzing the candles. You can call it back testing or whatever you want. And then the final one that we're going to have, that's actually, learning based, is going to be building a trade plan. That's going to be coming in the end of the month, the 23rd of this month. I'll be doing that. And that's where we put it all together, from by that point, we'll have done 8 or 9 of these classes. And so that'll be the class where we talk about putting everything together, actually executing on trades, building the plans before we enter the trade, contract selection, using everything that we've learned. We'll put it all together then. And then the final week of January is going to be just a Q&A. I always like to run one of those right after my course series ends up. A bunch of people have questions, and ideas and things like that. And so I love to finish it up with a Q&A. So with that, we're going to get started. Again, thanks everybody for being here. Dirty River, happy to have you. And tonight we are talking trading ranges. I talk about it all the time. I frequently mention range trading activity. I mention things to watch for in regards to ranges and how to trade in ranges. How do I identify them? How can you, draw them on your charts to make it more apparent to you? And then, why do I talk about trading ranges so much? And the main reason that I do personally is because the market spends most of its life in a range. Whether you're talking intraday or big picture or whatever it is, the market spends very, very large amounts of time in between areas. And a lot of people hate it. I love it. It's my favorite kind of trading. It's super easy. It's super cut and dry. Typically, the trades pay very quickly in a range. You are either right or wrong very quickly, which is how I like to trade. I know a lot of people like to hold all day, but what I like to tell people is I would much rather have 20% trades than 100% trade that I watch just go up and down and green to red and 80% profit to 20% profit. You're dedicating too much mental capital to the charts by trading like that. And so that's why I like to trade ranges. You have very, very cut and dry areas where you enter. You have very, very cut and dry areas where you stop out, and you obviously know where you want to be taking profit. So it removes a lot of the, I don't want to say guesswork, but it removes a lot of the questions from trading if you just accept that a lot of the time we're in a range. Of course, once the range breaks, trade it, trade the breakout. That's perfectly fine. But you need to acknowledge, people always try to say, oh, I'm a breakout trader. And, good for you. I hope it works for you. However, you're trading the less likely thing to happen in the market. As we all know, as I teach in my classes all the time, most breakouts fail. So you don't, trading breakouts is great. When you catch a big old breakout, it's awesome. I love it. It's awesome. You get to be in there, you get to be in there, you get to catch a nice move, you get to ride it for a while and not have to do anything. I understand it. It's nice. However, ranges are where big money can be made quickly for traders. If you're, paying attention, if you're very good at following rules, there you will likely find much more profitability in your trading if you learn to trade the ranges and you treat most things as ranges until the range fails. And so, another thing that I like to tell people, I think it's right around 65% of the time the market is in a range. So if you hate ranges and you don't want to trade ranges, that's fine. But also understand that, one, if you aren't good at trading ranges, you're going to miss a lot of breakouts, or at the very least, you're going to be chasing the breakouts. That's one of the great advantages to trading in a range, is that Without one, you will never have a breakout. You'll hear me talk about it, you'll hear Flips talk about it. Oh, I want consolidation. What consolidation is ranging. A range can be one candle, two candles, five candles, or on the daily chart, it can be weeks. You can spend weeks in a range. But without ranges, we don't get breakouts. So you always, that's what me and Flips or anybody, Tilio, anybody that says, looking for some consolidation at an area, then a continued move higher or lower. That's because we want to see that consolidation, the range, also known as a range, because that will give the breakout fuel. That's what you want. So the other advantage to it is it frequently gives you the opportunity to have an entry on a breakout that is substantially better than actually buying the breakout. You're kind of front running the breakout or breakdown, whichever it might be. If your trading ranges correctly, then you get the nice little front run on it and you get to be in there with a really, really great average price. And then by the time the people who trade the breakouts and have waited for that breakout to come, you can already be trimming into financed contracts and letting them run, and then you get to catch the breakout. But because your entry was so much better, you get to remove risk off of the table, you get to book some profits. And then, when people are just entering and they're chasing the trade, trying to catch that breakout, you might already be up 20, 30, 40%. So by the time they all start trimming their contracts 20, 25, 30%, you might be up 60, 70% and are doing much better. And it's because you understood from ranges comes breakouts. So how do we identify them? What are some things we look for? These are always kind of interesting lectures to do. I give this, disclaimer basically every time I give a lecture. When we're sitting here and we're looking at charts, and as most of you know, I'm a big technical trader. I love fundamentals too. I talk fundamentals and I talk that stuff all the time. But I love technicals. I love the charts. The charts are they're the only thing that ain't lying to you in the market. Whatever is on the chart is the 100% fact, and you can't argue with it. So I like to go back and look at charts. That's how I like to teach. That's what I like to teach people to pay attention to. You can be a solely fundamental trader, absolutely. However, you will make a lot less money than somebody who does fundamentals and technicals. So I always like to focus on the technicals. The issue with it is in these lectures, this is my normal disclaimer, we get a hindsight trade. So we get to go back in time. We get to look at days that have already happened and we get to say, well, I would have done this, this, and this. And that's great because we get to learn from it. We get to see, what could I have done different if I didn't do this, all of those things. However, it's hindsight. So it doesn't matter, but you remove all of the emotion. And we might be able to say, even here today, I think we caught some of this bounce this morning. I don't even remember, but we pushed up here to this trend, early this morning, and, we had a failed breakout down. We've now had a failed breakout up. So we're kind of looking for some range trading until the breakout comes. But we can look at this and look back and say, okay, this was our pre-market trend. Oh yeah, we would have shorted that. No questions asked, with stops over these highs. Well, I didn't today, but we can look back and say that. So I just like to give that disclaimer that, yes, we get to go back, we get to look, we get to say, hey, I'm the best trader ever. I would have done this, this, and this, and I'd be a millionaire or whatever it is. But understand that when these candles are actually printing, you might not be able to make those same decisions. And don't ever get down on yourself, don't ever feel like you're failing or you're just missing all these entries or anything like that. There's always more trades. Just go back and look at them, say, what could I have done different? And then maybe when it shows up, later, then we get to, we can say, hey, I've seen this before. I'm going to perform this way. That's, all we can hope for. But so with that, I'm just going to get the 5-minute chart on, or I guess I'm just going to get the 5-minute chart on. I'm going to add some days to it. We'll go back 30 days or whatever. Kind of start back here, way at the beginning 30 days ago. Funny enough, we were trading at the exact same levels we were trading at 30 days ago. And then I'm just going to kind of cruise these charts and look for range days. So here's a nice range day that we had. Obviously, this one is a very tight range day. I have no idea what this was. November 22nd, 2024. So nice range day. Now I want to talk about some things that help us and hinder us on range days. So EMAs. Everybody uses EMAs. I think everybody uses some form of EMA. I teach to use them. I personally don't take many trades based on EMAs, but I like to have them there to know, hey, we could have a little pullback. We could have a bounce here. Yeah, I'm rarely the one that's telling you to buy like dips to the nine. It does work, but I've just been blown out too many times for me to keep doing it. But I like to look at this, and I'm actually gonna get rid of this. Um, Give me one second. I'm gonna switch up my, oh, I bet you if I do. So again, here's our range day. And what are some things we could do? What are some ways we could identify this? How could we know that this is a range early? And so one of the things that I like to tell people to do, and I'm not going to do it right now because I'm on the 5 minute chart and I don't want to have to go back and find you know, the 22nd of November in the hourly chart. So something that I like to do is look for your first hourly candle that's going to close on the day. And so it would have been closing right up here. This is seven. Well, I'm West Coast time. This is 7 o'clock. This is where our first hourly candle of the day would have closed. And this is where we opened the day. So, we're a half hour into the day. And people always want to know, how do you identify a range early? How do you, identify a trend early? Whatever it is. Today we're talking ranges. So what my favorite way to identify a range early, and we're going to get into in the price action lecture, we're going to get into some of the other, tips and tricks that I have from actually reading the charts intraday. But one of the first things that I like to do is say, what did we do in the first half hour of the day, first hour of the day? And so what I frequently tell people to do is go to the hourly chart and look at that first candle that prints on the day, and you're going to notice that it's half in the pre-market, at least if you're on thinkorswim or you know not Weeble. They have a weird time schedule thing. But you're going to notice that the first candle of the day is half in the pre-market, it's half in the normal trading hours. Well, the first thing that we want to do is look at that once it closes. And this isn't the opening range. For me, that's the first hour and a half of the day, which is actually going to be over here. But highest high, lowest low, first hour and a half of the day is the opening range. This is just trying to identify range trading early to actually take advantage of some of it during the day. So our first hourly candle is going to close up here, and we opened right down here. So for today, I'm just going to use this box like this. This is our range. And people hate range trading. I get it, because you're always looking for a breakout, and the market. And this is something that I was teaching in pro the other day, and it's an Al Brooks thing, of course. The market has a really, really amazing way, especially when range trading, of showing you candles that convince you a breakout is coming and then doing the opposite. And so this just so happens, I mean, I don't know, I just picked a random day. We're going to look in 4 days. This just so happens to be a really, really perfect example of that. It's not always going to be that perfect, but ended up being a very good example of it. This is a nice bearish candle. Don't get me wrong, bouncing a level, bouncing our 20. So, I'm obviously not short down here, holding the opening price. I'm obviously not short down here, but how do you trade something like this is where people really struggle. And so it's simple. This is the explanation of how we do this. Once we've identified our range, which, this was our low, this was our high. So really our first entry, reasonable enough entry, is going to be down here. But how do you trade this, and what do you look for? And this isn't building trade plans. When we have that lecture, we'll do range days, trend days, analyze the big picture, trade around that in the intraday movement. So how do you do it? And it's, like I said, it is simple. The mindset of this is extremely simple. And I love range days because both sides make money. Of course, I think if you're bearish most of the time, you should probably try to fix that logic. If longevity in the market doesn't exist for bears. Bears don't last long. They're the ones who blow the ports all the time. Bulls tend to do better in the long run. But we have a range here. How do we trade it? Well, you buy low and you sell high. It's really that simple. You aren't always going to have these perfect low entries. You aren't always going to push right back to the highs to sell, those exact highs or anything like that. but you buy the bottom of the ranges and you sell the top of the ranges. Whether you are selling your calls up here or you're selling the market, you're shorting the market. You can also short the market up here. Both sides get paid in a range day. And you can see here, the breakout traders are getting smoked. All day long, they're looking for the breakouts that never come. They're looking for the breakdowns that never come. So we identify our range early, and until the market tells us we are no longer in a range, we treat it as a range. So you can see all day long, if you are long anywhere down, and obviously, technically speaking, this is an uptrend day, but like nobody would call this an uptrend day. Let's be real here. It was flat. But we were setting higher lows throughout the day. But if you buy longs anytime you get a dip down here, you make money. Of course, this one's getting higher and higher. I'm using the hourly 20, so this is real life. If I was trading this range, I would still be buying the dips to the hourly 20. Well, what's the actual plan? So the actual plan is buy as close to the bottom of the range as you can. And the reason that we want to buy the bottom of the range is because then our stop out is tight. You never trade the middle of the range. There is way too much uncertainty there. When you buy down here, you have like a 1 risk 10 reward trade. When you short up here, you have a 1 risk 10 reward trade. When you're in the middle, you got a 1-1. And you have to be a very, very, very good trader to remain profitable long term with 1-to-1 risk reward trades. So this is what the market does a lot of the time, is consolidate. So we treat the market as a range until it is no longer a range. We buy here, and my rule of thumb that I like to follow is if you're trading a range like this, you buy here, you trim the middle, and you fully exit. You don't necessarily want to be greedy for these highs up here. You don't want to say, oh, this is the top of the range, I want 596. You're within 10 cents of it. You take off most of the position, and then you move your stops up. Same as if you short up here, if you're shorting these highs of these candles, your stop's outside of the range. No big deal. Final target is somewhere down here, hourly 20, but you do the exact same thing. You want to enter as close to the extremes of the range as you can. You want to trim the middle, and you want to sell the lows. You want to get out down here if you're short, or if you're waiting for this pullback, you want to get long. And so you can see right here, again, this is just a 2 picture perfect of a day. Now that I'm thinking about it, that's Thanksgiving week. 2 picture perfect of a day. Ranges aren't always going to be this friendly. But they're a very, very great, low risk, high reward trade. So we're going to keep going through days. But does everybody get this? I want to see if there's any questions. Clandestine, how we doing? No, never change position size. Position size should never change. You need to have, it's fine to say, my scalp positions are these size, my swing positions are these size, that type of thing. But consistent position sizing is like one of the most overlooked things that people do. If you're trading with, $100, $100, and you're getting your 20%, and then all of a sudden you trade $500 and you stop out for 20%, you give back all of your gains plus some. So, keep position size uniform for your portfolio, and I can't tell you what to size. I think generally size smaller and look for more is a better way to do it, but I can't tell you what to position size, but consistent position sizing is key to success. You never want to have yourself in the position where one trade can wipe out 5 trades worth of gains. Stop loss profit target, I don't treat them like other, your stop loss is based on the chart. Your stop loss should never be based on a percent. It should never be based on, how much money you're losing. That's another thing that a lot of people struggle with. If you start trading the PL, if you're like, oh, God, I'm down $200, I'm freaking out, and you just stop out for no reason because you're red, it's not going to be good for you. You'll stop out of the whole port eventually. What I do, if I'm buying the bottom of this range, then my stop is a close outside of it. and maybe we bounce right back into it, but it doesn't matter. My rule is a close outside of it. And when I have stop losses, I always have two in mind. So again, we're hindsight trading. Not everything goes perfect like this, but I'm going to give you my examples of stop outs and specifically on ranges and how this might work. So I buy calls here. Okay. We're just saying that I buy calls here. My stop out is, if I'm trading the 5 minute or the 15 minute, is a 5 or 15 minute candle close down here outside of this range. Obviously, we had the hourly 20, so if we close like barely outside of it, I'm personally not stopping out. However, we need to have another stop loss in our mind. And so how I always describe these is, this is your perceived stop loss. Before I enter this trade, and I'm planning this on the way down, I'm not just seeing this candle and buying it. I'm saying if we come down to the bottom of this range, I am buying calls, and I know that way up here, and so this is my perceived stop loss. That's where I'll hopefully stop out. You also do need to have a point in your mind where you say, I am dead wrong. I am exiting this trade right now. Because you have to have a point where you just say no. And maybe the market bounces, whatever it is. Maybe mine is, if I start seeing aggressive selling, we broke hourly 20, we broke this, this candle doesn't bounce, this candle keeps going, keeps going, keeps going, I'm stopping out. I was wrong, that's fine, but I'm stopping out. Once the technical reasons I used to enter the trade are gone, then I'm no longer in the trade. So for me, stop outs are never based on, they are based on the chart, always, never based on the profit or loss of a contract. Then as far as profit targets, when you're in a range, a nice rule of thumb is about that 50% retrace. So that's halfway up. So if you're in calls and you get a halfway up bounce, you trim. Final profit target is up here. Now I will say, this is where you hold a runner and you ratchet up the stop. So I'm going to remove the box so we can see and we can just discuss this. We know down here is the low of the range. We know up here's the high of the range. Pretty easy to spot on a day like this. We enter calls here. And then we trim out of most of them because we get back to the top of the range. And of course, it didn't happen on this day. What I do, I'll bump my stop to somewhere right around here. And maybe I get stopped out, or now is where the real advantage to range trading comes. If the breakout comes, which as we know, that happens 40% of the time, 60% of the time, or 60% of the time we're in a range, 40% of the time we're trending, and 80% of breakouts fail. So, if you're looking for that breakout, you're really looking for the low odds trade, but whatever. If you trim here and the breakout comes, well, now you're going to have the breakout traders buying up here. So your entry's down here. You've trimmed. You're in huge profit, and you will catch more of the breakout. So use ranges to your advantage. And it's the same thing for breakdowns as well. And this was a whole day ranging. As we get through more days, we're going to show you more and more. Like I said, a range can be an entire day, or a range can be 10 candles. That's it. Oh yeah, I manually set everything. I manually set everything. But I will say, this is something that I talk about, and I'm always like wishy-washy on whether I should tell people to do it. I do not trade with hard stops, because of this kind of thing. This is a prime example. This candle right here is a prime example of why I do not trade with hard stops. If my stop is a break of 493.17 and I have my stop right here, the break of that level, I just got stopped out and I didn't need to stop out. So that's why it's always good for, letting candles close. And that's why I said my planned stop was a candle close outside of that range. This is one where if you had the hard stop, you got stopped out on a trade you didn't need to stop out of. We got Norman in the house. So yeah, So I like the opening range. This person saying always go by the first hour's low and highs to set up your range. So this is just something, and I guess I better just show you guys. So if you go to the hourly chart, let me get 30 days on here again. What day were we on? We were on was that like the 22nd maybe? Was it this day? Yeah, 22nd. Okay, so here we go. go to your hour, and this is just identifying the range. If there's gonna, if there is one, and this one, it won't always work, but it's a nice way if you're trading to pay attention to. Go to your hourly chart. That's what I have pulled up right here. Look at the first candle of the day. If we're just staying within it the whole time, which we did on this day, then we're in a range. This candle printed the first 30 minutes of the day. So we already know where we want to be short, where we want to be long. And so it's just a very easy way to do it. But maybe the range takes an hour and a half to set, it can always change. This is just a nice early range identifier. Okay, so with that, now we're going to start going through a few more days, a little bit more quickly, trying to just identify some nice ranges that we could have traded. So we're here, and I'm just going to scroll through it. Let's see. Yeah, so cornbread happens to everybody. So here's the issue. We're trading in a very, very volatile market. We are, it doesn't matter what you're trading. I'm not just talking same days, weeklies are moving, because most of us, let's be real here, we trade those big, we trade your Apples, your Amazons, Microsofts, Nvidias, Teslas. We trade the most volatile names in the market. If you set a stop loss on any of those that's within $5, you'll stop out 99% of the time. Because that's just how volatile they are. You really gotta, when you start looking at option Greeks and you realize that basically your contract is going to gain, or if you're in a reasonable contract, close to the money, things like that, your contract is going to gain or lose, let's say $50 for every $1 that the stock moves. So on something like SPY, you're going to make or lose $50 for every $1 it moves. Well, that means if it moves 10 cents, which, let's be real here, SPY moves 10 cents in the blink of an eye, you're going to lose that $5. So too tight of stops will always get stopped out. And it kind of goes back to why, I rarely use a hard stop. I start to use hard stops as I'm trailing into profit, but you want to have those stops based on something on the chart. That's something we went over in the trending lecture last week. Use the candles to tell you. Move your stops to highs of candles if you're short. Keep them at these highs. You get another high, move your stop to here. You keep pushing down, move your stop to here, because you want your stops based on the chart, not based on, see green, got to protect the green. My rule of thumb is if I trim, I move my stop. That's when my stop gets moved up, is when I'm happy enough to take some of that profit, that stop now moves into profit. But it might go, if I'm trimming at 20%, my stop might only go to 2 or 3% green, because, I still want the trade to breathe. Well, if I want the trade to still be able to breathe, then I let it do it, and if not, then, I'll ratchet the stop up pretty tight. If I'm happy with those gains, I'll frequently, and this is, getting a little more advanced and a little off topic, but if I'm not selling by way of limit order, like if and we'll just do a random one, I enter calls here, I'll frequently set a limit order at this next level, really just below it, knowing that's where I want to get out. If I don't do that and I'm expecting a breakout to continue, then, say I have 3 contracts. Well, when we get to my trim level, I'll set a stop right there for 1 contract. So maybe the contract can keep going, or maybe my 1 contract still pays me the profit that I was happy with. And then I'll keep my stop on the other contract still down here. And then as we move up, I can bump that stop up a little bit. Do you know if you can set stop losses on Robinhood? Yeah, you can. I think it's about 50-50 whether or not people say they work. Toasty swears by them. I've never had much luck with them. And when they do they fill me at such a bad price. It's like horrible. Yeah, and managing trades is always going to come down to contract selection. Okay, but we're talking ranges here, everybody. So, trading ranges, this is a bit trendy of a day, but here we go. Here's a nice one. So, we're using our same idea here. This is still going to be that first hourly candle of the day. However, this is a range that breaks. This is our range that breaks down. Well, we ultimately form another range. So you can see here, this was our initial range, broke it down, shorts paid. Well, this is what I was talking about. You can have many ranges in the day. This one was a, a failed breakout that turned into a trading range. And here is the range that I like more. We get this nice sell down to the hourly 20. Again, we are dip buyers here. We are short rippers here. It's a range. We're well below EMAs. We're well below all of that stuff. So maybe you feel a bit more comfortable shorting as opposed to buying these dips. But you buy the dips here. You buy the dips here. You buy the dips here, looking for moves halfway up and then top of range. You can see works great, works great. Only gets you halfway this time. That's when you start to say, do not, do not buy calls this time. As I've taught, as I teach over and over, I always try to repeat these statistics. So they really beat it into your brain. I beat it into your brain. 80% of breakdowns fail. So I'll buy it once. I'll buy it twice. I'll buy it 3 times. Fourth test, I'm probably not buying it. Fifth test, I ain't buying it. That's just how I trade. I always use those statistics and it saves me heartbreak. Then again, we get the breakdown here. So, again, this is range trading, so we're not really going to talk about it. Well, now we've had the breakdown. So you short the bounces to the bottom of the range, looking for a move down with stops back inside of it. But you trade this range. That's, all you can do. And so look for those. They happen every single day. We do have those just blowout trend days, Here's basically a grind up trend day all day long. But for the most part, we will find some sort of ranged movement. Again, maybe it's just right up here, it's just it's a quick little range right here where we're buying the dips, we're shorting the rips, and you can see this is one where, hey, you short these rips, you're in the trend early at less risk. Of course, you can wait for the breakdown retest, but we're talking ranges today. Always look for ranges because we get nice range movement. That's people building their positions. We're buying dips and making money. We're shorting rips and making money. And then, obviously, if you bought this dip, you made some money. If you bought this dip, here's a great example of here's your stop out. You ended up having 15 cents of risk on the trade if you bought this one on the way down. Here's your stop out. No big deal. You're going to lose, on a SPY contract, you're losing $5-6. That's it. You're going to lose $5 or $6 on this stop out right here. So, and then the range is now broken and you can start to, maybe look for some trend trading, look for a trend to develop, whatever it might be. But always identify these ranges. And then again, as you can see, they're easy, here's a nice blowout trend day. And as you're noticing, they're pretty rare in the grand scheme of things. And we ultimately find ourselves in a range into the end of the day. Let's see. A lot of ranged movement here with a slow grind up. But again, we'll just use our first. Here's our, it's 7 o'clock for me. Here's our highs. Here's our lows. We're shorters up here. We're dip buyers down here. Obviously, if you short this, you get stopped out. No big deal. It does develop into a trading range, obviously, a bigger trading range right here. But we made money buying this dip. We made money shorting this rip. We made money buying this dip. That's all that happens. Now the people who went looking for the breakout are smoked, The breakout traders almost always end up smoked. The range traders get to be in there early, make their money, move on. Again, even later in the day, anytime you want to see a range, look for the recent high and the recent low. So to me, this is, we tried to range, we tried to break out, we pulled back. Here's our recent low. Here's our recent high. You identified after these candles, you have your consolidation. If you like to draw boxes, I like to draw boxes. Here you go. Here is your range. You buy all of these dips. You buy these dips until you get blown out. But you get scalps halfway up the range. And this is a small range. This is a buck. Yeah, just short of a buck. Plenty of money to be made right there if you're scalping some reasonable contracts. You buy dips. And then when you're wrong, you stop out. Sometimes you're going to get this kind of thing where you stop out and it goes back in and breaks out. But they get you back in the range. You feel comfortable long here. You feel comfortable short up here. Again, maybe you get blown out or maybe it drops back in for you. But you always, always, always look for ranges and you always assume that they will not break. Here's a nice one. This was likely, this would have been opening range. So this isn't going to be your first hour of the day or whatever. But here's your opening range, what would have ended up being your opening range. Even this first hour range, it looks like that nice dip buy would have worked for you. But you break down, here's your opening range. So you start to feel comfortable knowing that, you're likely trending or you're likely ranging. So you buy these dips with tight stops. As you start pushing back up here, hourly 20, top of range, you look to short these. You don't go looking for runners, you go looking for that little thing. Then we dip back down. I mean, double bottom, opening range, you buy this with tight stops and you look for the move halfway up. If you're lucky, you get the move all the way to the highs. Up here, you I won't say you always look to be short, but you don't buy longs here because you can see most breakouts fail. Here's 1, 2, 3, 4, 5, 6 failed breakout attempts, the pullback, and then ultimately the breakout retest paid you a couple of bucks. But you made so much money trading the range, you don't even care about that end of day movement. Leave that to the, people praying they can go red to green from SPX or something. You don't need that because you made enough money. Here we go. Nice. This got too tight. I mean, 20 cents. There's money to be made. It's not for the faint of heart, though. If you're a greedy trader at all, you can't trade stuff like this. However, if we do pull this out a little bit, you start to see this pull back down here, hourly 20, bottom of a range. Risk reward suddenly starts to look pretty decent for the long here. Maybe not a lot of info. You could have been shorting these highs. Obviously, there's money to be made shorting those highs. You don't really want to buy calls middle of the range, as I told you. Always avoid that middle of the range trading. We pull back down. Now you start to look to be long, and we get this really awesome example of if you aren't fully out here, which, on a nice range day, you probably should be, but maybe you hold a runner, you front run the whole move upside. While everybody else is waiting to buy here, you've already rode SPY up for $1.50. So you're happy on that. Oh, let's see, we got some questions. Do I use the tape? I do. Do I think it's necessary? Absolutely not. I do like to use the tape just to see where some of those sell orders are sitting. But let's be real here, unlike SPY and QQQ and stuff, your brain can't keep up fast enough. When I do use time and sales, and level 2, of course, time and sales, I always set to a high filter. And then level 2, I like level 2 more than time and sales because you can see the orders start to get out of your way. So it can be helpful, but far from necessary. Gail, it all depends on the day. Of what the range is going to be. Is it going to set that first, hour candle of the day? Is that going to be the range? Maybe. Is it not going to be the range? We just don't know. I just think that you are always better off looking at consolidation and treating it as consolidation. Ranges are, as most of you guys know, I don't trade bull flag, bear flag. Like I don't trade that stuff because here's a really great example of why I don't do that. We pull down, we start to consolidate. From these first couple candles right here, I'm saying range, no questions asked. The bear flag traders, the ones trying to tell you this is, bear flag, short SPY, stay short, and they get blown out. I'm buying all these dips because this is a range. It's got nothing to do with the early candles in the day. It developed much later in the day, gave us a nice little range where you want to be buying these dips down here. And it's not always going to work like this, but you buy your dips down here, you trim, halfway for the move of the day. And then ultimately your opening range top is up here. So you get a front run this whole move and have the best entry while the bears are still late to the short looking for a bear flag. And it happens on bull flags as well. Sometimes you push up, you consolidate at the highs. People are like, bull flag, bull flag, bull flag. I call it consolidate, I call it a range, and I short the highs of the range. And then, so that's, look for these kinds of things all day. Here's one develops a bit later in the day. You look for your recent lows, you look for your recent highs. You're a dip buyer. This is a weird one. This one, I'm actually happy this one popped up because, I've been telling you time and time again, don't trade the middle of the range. When the middle of the range is every single EMA, every single VWAP, candles are not getting over them, then you can kind of start to say, okay, maybe my range is a little tighter than I thought, and I should be shorting these bounces. Perfectly reasonable. Your stop gets widened out a little bit, unfortunately, but we buy dips and we short rips. That's all we can do. And like I said, they show up most days in the market. You're going to have some form. Here's a great one. So obviously great big consolidation up here at the highs. You know, we've you can be shorting these. Let's see. I mean, you got 50 cents. There's some money to be made. Nice, great big consolidation at the highs. Bulls definitely looking for a breakout. Bulls are on the 15-minute trying to tell you that this is a bull flag. Well, I'm shorting these highs, short these highs, short these highs, short these highs. You can buy these dips as well, buy these dips. But it goes back to that thing. We're failing to break out. We're failing to break out. Failure, 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 over and over and over again. At a certain point, you have to start to say, okay, I feel comfortable being short. I do not feel nearly as comfortable being long. We're getting all of these rejections up high. Obviously it's straight sideways. I'm sure people were losing it, whatever day this was, 6th of January or of December, not a good day. And then you're short on these bounces. So maybe you get a front run the breakdown. That's the type of thing you want to look for. Okay, let's see. I'm way behind on questions here. Yeah, hourly range. And like I said, it doesn't necessarily have to be an hour. It doesn't necessarily have to be, it can be 30 minutes. It can be 3 hours into the day. You just want to identify highs and lows and trade them. And if we're staying between them, just keep on trading them, keep on hammering them, look for those double bottom types of things. Always assume we're in a range until you see a very strong trend forming. I mean, even okay, so we've done enough days. We only got like 10 minutes left. Let's look at today because today was an interesting one. I know, let's see, we're way down here. I know it brought people some strife. It had a good amount of confusion going on in the market. So I'm going to remove all my trends. I'm going to remove everything. So first, hour of the day, boom, right here. Happens to be right here. So that's when our first hour of the candle, or our first candle is going to, or hourly candle is going to print for the day, is going to be right up here. So at this point, we can start to say, and we have other things, and I guess we can talk about this. This is real life. This is what, a lot of us were watching today. Pre-market trend. I always recommend watching pre-market trends. We have our first hourly candle printing. Again, I didn't get short up here. Not going to pretend like I did or anything like that. Plenty of reason to be short up here. You now have a range formed. So when we pull down to here, you buy this dip and you get the bounce. Maybe you buy this dip and it's a tricky one. We're still planning on range trading. Maybe you take the stop out a buck, 50 cents below you. That's perfectly reasonable. That's like no big deal. You can always get back in if you need to. And so maybe you buy this dip, you make money, you get your move halfway up. Again, we dip down, we buy back in. Maybe you buy this dip and then we push back up here. Well, we can see, just always look left on the chart. That's how we find ranges. That's how we find all of that. Always look left on the chart and look at these highs. And so what do we do here? And again, this is hindsight trading. I didn't catch this trade. If somebody would have asked me about it, I probably would have said, hey, I don't hate that. We have right here a nice little consolidation build. You can see it's kind of in the middle of our previous range, but we're having a lot of sideways movement. So we can be these dip buyers down here. We can be these short rippers up here. The second this breaks, obviously, if you're long, you're getting blown out. It's unfortunate. It's one of those times where you do get blown out. But if you're short from these highs, which you should have been on this candle because we know this is our range, so you would want to be short here, maybe you get this move down, and hopefully, if you're lucky, like I said, I didn't, but maybe if you're lucky, you move your stop about halfway and you front ran the whole move for a reason. You didn't just chase red candles like a lot of people do. You were short at highs where you want to be short and you get the breakdown. Well, then we come down here. And this right here is consolidation. I don't care, like, this is consolidation. I don't care if you put your box here. The one that I was actually trading today was I went for basically this candle and counted these as failed breakouts. This little move right here, counted these as failed breakouts. In Pro VC, we bought this dip like 10 times. And every pullback down, we bought all these dips. I mentioned to people, hey, if you want to be short, great, on this one. And then, oh, actually, one of these, it was on QQQ. Yeah, it looked basically the same. We shorted this candle on QQQ. Imagine it looks about the same. We shorted this candle, paid, and then instantly wicked back up. And I stopped out and lost money on that. I know other people lost money on that too. But then again, now at this point, we're above EMAs. We're holding the tops of the range. We're doing all that. We were dip buyers here all the way into close and definitely happily rewarded just based off this range, and it could work the same ways. People shorten it. There's a couple, that people, it's hip, it's cool to be bearish, I guess. I don't know. So there were people shorting it. But for me, I made it very clear to them that I was looking for a nice bounce into close. And ultimately, we got that nice little bounce into close. Okay, so question time. You can draw a range from wherever it is. That's another and this lecture, it got away from me. So here's SPY right now. Let's see. Oh, inappropriate jokes on that one. Maybe we got a blank one here. Okay. So SPY. And as if anybody doesn't know, you obviously don't go to my lectures. I do most of my charting on the daily time frame because it is the most important time frame for information. Well, here's SPY. Here's SPY's range. Here's SPY's range that we identified, in the beginning of November. Here was our lows. So last couple of days, well, we know from ranges, most breakdowns fail. So when we're at the bottom of ranges, I'm hoping, this is a question for all of you. What do we do at the bottom of ranges? We buy them. We buy calls. So when you saw me and everybody else for the last couple of days roasting everybody trying to be short at 584, here is our reason why. It's because of the daily range. There is not an easier long on the market for where we are trading than that 583 to 584 zone. If you aren't looking for dip buys there, I just don't know what to tell you. Then if you even look, we'll just put one level on the chart. This big wick candle from, that big overreaction to FOMC, big wick candle. So now we got one line on the chart and we have one range. What do we do at 581? We buy calls. No questions asked. Maybe you bought calls here and you got blown out. Perfectly reasonable. These candles were so aggressive, though. I hope that people wouldn't just blindly jump in front of those, obviously, But from the daily time frame, a range and one level. It was all you needed today. You didn't need much more than that. Obviously, if you were short, the range low could have been your target. Who would short this? Only people who don't look at charts. Very, very reasonable to buy this. And so we did. Okay, let's see questions. But yeah, trade your ranges from anywhere. Daily time frame, 4 hours, doesn't matter. Find your range. If we are in a range, treat it as a range until it breaks. Do I limit myself how many trades I'll take in a single day? No. No. People should. People are really bad at calling it quits, unfortunately. So people should absolutely limit themselves on the amount of trades that they're taking, What I think is more important and kind of and so I'm different because this is my full-time thing. So this is where my income comes from. So I kind of got to take trades, you know what I'm saying? But a nice rule to follow, if you're green on the day, you can never go red. That's a no-brainer. If you are green on the day and you go red, terrible trading, stop. Just stop right then, come back the next day. But a thing that I like to follow, and I think a lot of people should follow, if you're green on the day and you keep, you keep taking trades because the market's presenting you trades, so you take those trades. When you stop out of one, call it quits. That's it, And so, there's days for me, there's days where I take 3 trades. There's days like today where I went back and looked, I took 16 trades, It's not always going to be like that. But I just take what the market provides me. Yep, Gail, you got it. Somebody posted the hourly 20 script. But then I see people saying, do you do the settings? And now I see somebody saying they don't. I do. So it comes set to the 50, the hourly 50, I think. What does it do? Let me pull it up. Just so I can give you the correct answer. So it comes preset to the hourly 50. That's what length is. I change it to hourly 20. Hourly 50 works really, really good too. Oh yeah, Narvin, big mistake. Always got to bump those stops to profit. No, I would definitely not say this is a supplemental thing. I would say that this is what most the market does most of the time, and if you just trade ranges, you will make more money. Like breakout traders get destroyed all the time because they always think the breakout is coming and the breakout is often just not coming. Good range traders make so much more money than breakout traders, and they don't have to sit and panic, you know. So not only is it easier, it's definitely more profitable, and it takes way less mental capital, you know. I mean, even to today, like, no, I don't want to hate on people or anything. Like, I'm not, no disrespect to anybody. People were shorting this heavy, heavy. They're shorting this the whole, they're shorting this whole bounce up, saying, "No, I'm bearish. I'm bearish. The market's going to go down. The market's going to go down." And then SPY moves $4 against them, and then the breakdown comes, and they say, "I told you so." And beyond the fact that you're short here, you aren't even in profit until here. That's nothing to be proud of. You were dead wrong. I mean, the market blew you out, and then it turned around and you got saved. That's not good trading. It's nothing to celebrate. When you need this kind of a dump just for your bad entry contracts to get back to break even, you didn't call it. You didn't know anything. You got saved by the market. And so trade what the market gives you. And if you're short here, horrible entry. If you're short up here, then all you got to do is look right here. We have this high. And so, we're treating this as a range. I know this is a circle. We're treating this as a range. We short the highs of ranges. We short the highs of ranges. So up here, and it even happened in trade floor. People were asking me, "Oh, it calls here," and I said no. And then somebody asked me, well, short, and I said I would have liked it. They were actually asking me about right here. I said I would have liked it up here. I think we had VWAP or something. VWAP, all the EMAs, everything were hammered up here. I said I would have liked it more up here, but yeah, obviously you're at the top of the range, so you short it. Uh, so volume is tricky. I think most people use volume wrong. I'm going to do a lecture on volume, so we aren't really going to get into it tonight. It's a little bit too much. But I normally have multiple, volume scripts up. And what I always like to tell people is, well, whatever, I'll do this one. So I have multiple volumes. I got this one down here. It's just your standard bars. It does really, really good for showing you the volume is increasing or volume is decreasing. I'm not too concerned with what the numbers are. I do like this one. It tells me, the average selling over the last 9 and 60 candles, that kind of stuff. So decent information to have. But I use this one up here a lot more to show me not only which side is winning in the big picture, but it shows me exhaustion. If buyers zero out, I'm probably going to look to buy calls, because the sellers are likely going to be exhausted. If sellers zero out, I'm likely going to look to buy some puts because the buyers are frequently exhausted. I never care about the number. You hear people say, "Oh, low volume, it's bad," blah blah blah. And like, we had 49 million volume today. That's definitely low volume, and SPY sold $9. Like, low volume is a blessing for options traders because the moves happen much, much easier. Bigger moves happen on lower volume. Big moves happen on very low volume and very high volume. Not so much the in-between volume. But when there's very low volume, there's very little push and pull in the market. So when buying starts, it's pretty easy to push it. When selling starts, it's pretty easy to dump it. Does this work for small accounts? It works for all accounts. It works for good traders. It works for traders that trade the chart. I don't care if you have a $200 port or a $200,000 port. Know how to trade ranges, and you will start making a lot more money. You'll quit letting green go red. I mean, they just make everything so cut and dry for you that it is for all traders. I mean, we did it. We did like, I mean, I don't remember what we did in pro the other day, but we had a rangy day. What day was that? Oh, it was actually just this one in the morning. This one in pro, we hit calls, puts, and then ultimately those puts ended up paying really nice. But calls, puts, and then I was all out here. We traded this range. That was all we traded. I will 100% guarantee you I made more money than somebody who held for the whole trend down. No questions asked. Like, you make 50%, 50%, 50%, 50%. So you're up, 200% total. And maybe you get, 150% on one contract, moving it down to here. That's it. So you make less money on the downtrend than you could have made just not, and then anybody who held this whole time short, they're deep red, green, deep red, green, and then finally more green. But they had to suffer for an hour and a half. So I just don't do that. Um, hunting breakouts is rarely the move. Don't even worry about it. Like about volume level or worry about volume. You got to learn volume. Best way to learn volume, just watch it. Level two and time and sales, you don't need them. I mean, they're fine to have, but uh, most, yeah, like me, I don't use them that often. Till you don't use them. Um, and I'm always happy to tell you, um, I'm always happy to tell you what I'm seeing on volume when it's going on. But one of the reasons that I've never done a volume lecture is because volume is very hard to decipher after the fact. You want to see what the volume is doing throughout the day, because we look at the volume now and, you know, now there we got more sellers than buyers, but not by a ton. And then at one point we had zero buyers, at one point we had zero sellers, and so volume is a tough one to teach about after the fact. Volume is best learned just watching the market. Yep, Ryan, all of them pinned in my tab. Every indicator. Maybe not this bottom one, but I'll get it pinned in there tomorrow if you remind me. Every indicator I use is pinned in my tab. Yep, exactly, clandestine. Give me those one or two, whew, give me this. This right here is paying you so much money. Even these quick flushes down, that's where the real money's at. Obviously this one today, big sell. You know, we made some money in this range, but I ain't here to tell you that we made more than people made on a $6 drop in 30 minutes on SPY. That's just not the facts. But days like this are just sells like that are just so uncommon. How many contracts should new traders buy? One or just one for sure. Or paper trade. I like what clandestine says. Well, this is VWAP and hourly 20. If you don't want that, then just get the hourly 21. Okay. Is that going to do it for everybody? Thank you all so much. I see we had a nice crowd, obviously thinning out now. Thank you everybody for being here. If you got to get out of here, I appreciate you very much. And we'll probably be calling it a night here. I'll be trading premium VC tomorrow morning for a little bit of Friday fun. So hopefully we'll catch you all there. Yeah, thank you everybody. I appreciate you for being here. Nice turnout. And if you got any questions, feel free to shoot me the DM. And let's talk about it. And trade some ranges, safe, fun, pay huge. Yeah, teach you to not be greedy. And you can often hit a few nice trades, call it a day while everybody else waits for a trend to form and watches their contracts die. So, yep, thank you all. Reddit open. I do open. I don't know. I'm normally there for an hour and a half, 2 hours, depends what's going on. Can we talk about one more thing? Is it AT&T the greatest stock ever? Yeah, we can talk about one more thing. Position sizing compared to port size. So you need to analyze two things. How risky, if it's like same day Fridays, 5 minutes to close, tiny. But generally speaking, what I tell people, and it's difficult when you have a smaller port, 5%, pretty reasonable amount to have in a trade. Obviously, the bigger your port gets, less percentage. You want to, you don't, just because you have a lot of money doesn't mean you need to trade with a lot of money. And then on the other end, say you have a $500 port, finding, and on things SPY, QQQ, Tesla, all that stuff, you really shouldn't be trading them with a smaller port. I know people don't want to hear that, but finding reasonable contracts that are 5% of your port is tough. So there is a very unfortunate side of if you're trading with a smaller port, you are most of the time going to be over leveraged, especially if you're unwilling to go trade some of those slower moving names, your Walmarts, Disney's, AT&T, Coca-Cola, uh, ChargePoint. That was a good one back in the day. SoFi, and SoFi's getting a little more expensive to trade, but SoFi, a lot of the airlines, American Airlines, Delta, those are all cheap. They have very cheap contracts and they pay really great. If don't listen to anybody if they tell you otherwise. They will pay you very, very well. But it's tough to stay at that 5% threshold when you have a $500 port because let's be real, a $25 contract, even on, your AT&Ts or American Airlines, it's hard to come by for a reasonable strike. So if you have, a $500 port, you're definitely likely going to have to bump that up to, 10, maybe even 15, maybe even more percent of the port in a trade to have a reasonable contract. And so while it's riskier because you have more money, it's also safer because you have a better contract, but it is a pretty tough balancing act. But generally, I recommend about 5%. Obviously, if you have $100,000 port and you're newer to trading, you got no business putting 5 grand in a trade, you should really size it down. But 5% is a nice rule of thumb to stick with. Okay, and if that is going to do it, thank you so much, everybody. I really appreciate y'all for being here. Thanks for the support. Thanks for listening to me. If you like the lectures, make sure you let MMA and Tilia know that you like them, and we'll keep on doing them. Well, thank you all so much. Have a great rest of your night. And like I said, we'll catch you tomorrow morning.